Hey guys, Muscle here, Certified Financial Planner, and welcome to OnVisor TV. Now, today we're going to cover a investment approach often used by investors and advisors alike, and we're going to basically show you which type of a strategy you should be avoiding and which investment strategy or investment approach should you be adopting more than another. Now, essentially, what I'm getting at is a lot of people want to pick the best of two investments, investment categories, or a lot of people want to know when they should be invested and when they shouldn't be invested. So they want to know exactly when a crash is done so they can invest, and then they want to know exactly before the market crashes so they want to be out. Or they want to know whether stocks are going to be better than bonds, or when are bonds going to be better than stocks, and vice versa. So most people tend to want to adopt what I would call a barbell investment approach, meaning they kind of want to always be in the one that's going to win next year, or the one that's going on its way up, and avoid the one that's on its way down. And that seems fair. Doesn't that make a whole lot of sense when you think about it? Of course you want to be in the investment category or the right investment at the right time. The problem is that that's really, really hard to do. And that can be explained by this nice little graph here. So if we want to think of the percentages of chance you have at being right, that looks a lot more like this. Meaning you have a hell of a lot more a better chance being invested in the middle and owning both than you do by choosing either one of these on the end. So again, this makes a whole lot of sense until you realize that owning the right investment at the right time is nearly impossible. And you might do it once, you might do it twice, but to do it consistently is nearly impossible. Your odds of success are dramatically decreased. So what you want to do instead is adopt an investment strategy that does the opposite, that gives you your max exposure to both so that you follow your odds of success. That is essentially called diversification. So if you have 2 or 20 investment categories you can invest in, don't try to pick the 1 out of 20 that's going to be good for you next year. Again, 1 out of 20 will be the best one, but your odds of picking that one at the right time are probably less than 1 in 20. So, especially if you consider doing it consistently, which is nearly impossible. So what you want to do is own all 20 categories. You want to spread your money out as much as possible and as consistently as possible. Don't get me wrong, you can go and choose a side slightly and maybe adjust, but you know what? Going out off to the side slightly here still gives you a hell of a better chance than what you had at the ends. So what you want to do is start from the middle and then maybe tweak from side to side. So don't try to pick don't go all in or all out, because that is over time not a great winning strategy. What you want to do is own a little bit of all investment categories, diversify properly, give yourself a good chance of success, and then maybe stray from there once you learn the basics. So that's what I had for you guys this week. Hopefully this was valuable. If it was, please share. Until next time, cheers guys.